Hey, when you see a headline that says the Fed just cut rates, do you instantly think, sweet, mortgage rates are about to fall and my payment's about to get way cheaper? Listen, if that's you, you're not alone. But here's the deal. A Fed rate cut and then your 30-year mortgage rate are not the same thing. Sometimes they move in the same direction, sometimes they barely move at all, and sometimes they actually move opposite of what you'd expect. So in this video, I want to walk you through what the Fed cut actually means for your payment and how to decide whether you should buy now, wait, or just stop staring at rate headlines all day and focus on your own numbers. I'm also going to show you how waiting for that mythical perfect rate can quietly get eaten up by the rising prices and taxes, especially here in Texas. By the end, you'll have a simple way to think about this so you're not getting whiplash every time the Fed makes an announcement. My name is Matt Robertshaw, and I'm with Nexa Lending. I've been originating loans for over 2 decades, and I spend a lot of my time translating Fed decisions and mortgage-backed security movements into plain English game plans for my clients. I specialize in helping buyers who are very payment conscious. People who say, Matt, I don't need the perfect rate. I need a payment that I can live with. And I help them structure loans and timing so that they're not gambling their home search on the next Fed meeting. So let's start with the basic misunderstanding. When the Fed cuts rates, it's lowering something called the federal funds rate. That's the rate banks charge each other overnight. It's a short-term rate. It directly influences things like credit cards, some home equity lines, and certain adjustable loans. But that's not the same as the rate on a 30-year fixed rate mortgage. Those longer-term mortgage rates move more off what big investors think about inflation and the future of the economy. So imagine this. The Fed cuts its short-term rate to help the economy, but at the same time, investors start to worry about inflation and it might run hotter down the road. And if they get nervous about inflation, they might actually demand a higher return on long-term debt, which can push mortgage rates up, even while the Fed made those headlines. You see, that's why you'll sometimes see a quarter-point Fed cut, everyone celebrates, and then you call your lender and your quote is basically the same as last week. Now, does that mean the Fed cut doesn't matter at all to you as a homebuyer? Not exactly. I mean, over time, a series of Fed moves that successfully cool inflation can be a good thing for mortgage rates. Because if inflation expectations drift lower and the economy looks more stable, that can help longer-term mortgage rates ease. So the Fed can influence the bigger picture direction, but you don't get a one-to-one same-day discount on your home loan every time they make that announcement. So how should you think about this if you're payment conscious and maybe a bit nervous about making a move? Here's the first big shift in mindset. Stop trying to time the announcement and start timing your life and your math. Let me give you an example. Let's say you're renting in a place like Hays County. Your rent keeps creeping up every year and you're watching rates like a hawk. You see a Fed cut and think, I'll wait for 2 or 3 more cuts and then I'll buy. But while you're waiting, homes in your price range keep going up. Property taxes may adjust. Maybe insurance costs change. By the time you finally feel good about the rate, the house that used to fit your budget might cost more, and the tax bill that comes with it may also be higher too. So even if your rate is a little lower in the future, your overall payment might not actually be better. This is what I tell people. Let's run your numbers based on today's reality, not just your hopes for tomorrow. What do homes in your area you want right now actually cost? Let's think about that. What does the total payment look like with taxes, insurance, maybe HOA, and a realistic interest rate quote? Then we ask, does this fit your life, your savings goals, and your risk comfort level today? If the answer is yes, then trying to outguess the next few Fed decisions might not be the best use of your energy. You can buy a home that fits today, start building equity now, and still keep the option to refinance down the road if the longer-term mortgage market improves. That's the date the rate marry the house concept, but with an important twist. It only makes sense if you're buying a home that works for your budget as it is today. On the flip side, there are people where waiting absolutely makes sense, but not just waiting and hoping. If your numbers are tight, maybe your debt payments are high, your credit needs work, or the payment on the home that you want would stretch so much that you'd be worried every single month. Then sitting back and saying, I'm going to wait for a lower rate is not a plan, it's a wish. A better approach is something like this. You and I sit down, we look at your income, your existing debts, and maybe the types of homes that you're aiming for. We might see that if you pay down a couple specific debts, or maybe clean up a late payment or two, or build up your savings to a certain comfort level, that you're not only becoming more comfortable mentally, you may also qualify for better pricing when the time is right. That's waiting with a purpose. Instead of just scrolling through rate headlines every few weeks, you're actually making your file stronger so that whenever you do buy, whether rates are a little higher or lower, you're putting yourself in the best position possible. Now, let's address current homeowners for a second. When the Fed cuts, I always get people asking if they should refinance everything. The answer is maybe, but not automatically. A Fed cut might help certain types of short-term debt move down. So if you have a home equity line that adjusts, or other variable rate debts, it can be a good time to review whether you can simplify your structure. Sometimes it makes sense to consolidate some higher interest consumer debt into your mortgage and clean up your monthly cash flow. Other times, stretching that debt over a longer period for a slightly better rate actually costs you more overall. That's why we look at the whole picture. What you owe, how long you plan to stay in the home, and what your future goals are, not just whether the Fed moved by a quarter point. So if you're still with me, you can probably see why trying to trade the Fed is a rough way to plan your home life. This stuff is complex. There's inflation, bond markets, local home prices, and then your personal budget and timeline layered on top of that. Calculating all of that in your head or off of a couple of social media posts is a headache. So I put together a simple guide that walks you through how to think about the Fed cut, how to look at your payment in context, and the key questions you should answer before deciding to buy now or wait. It breaks this down into plain language so you can sit with your numbers and feel calm instead of confused. It's completely free and it's linked right down below in the description. So, don't let the headline hype or fear of making a mistake keep you stuck in neutral. Click the link in the description or grab the guide to book a strategy call with our team over here at Nexit Lending so we can plug in your real-world numbers and map out the smartest path for you. We'll look at your payment comfort zone, your timeline in the home, and how today's market in your area lines up with your goals. And if you found this video helpful, feel free to subscribe. See you next time.